Why might an advisor recommend an investment bond for their clients?
An advisor might recommend an investment bond because it's a non-income producing asset, which effectively means that there'll be no UK income tax liability unless a chargeable event takes place which results in a chargeable gain. A chargeable event can occur upon surrender, death, maturity, or an assignment for money or money's worth, or where a withdrawal takes place in excess of the 5% allowance. The 5% allowance is a benefit of investment bonds as it allows the bondholder to take up to 5% of the total premiums paid each year without incurring any immediate income tax liability. Any unused allowance in the year can be rolled forward to future years.
Why might an advisor recommend an offshore bond for their clients?
There's no internal taxation within an offshore bond, which means that any investment growth gets to grow free of tax, effectively what we call gross roll-up. With a UK investment bond, deductions are made to satisfy the individual investor's basic rate tax liability, and this is done on an ongoing basis. Now, whether or not one is better than the other for a UK taxpayer depends on a number of circumstances. For example, how long you're going to hold the bond for, what the tax position is when you take the bond out versus what the tax position is when the benefits are taken. But once you get into the realms of having somebody within the lifetime of the bond, if you like, who is not a taxpayer, the issue becomes, well, why would you pick something which you're going to have tax deducted from? Don't use an onshore bond because you're going to end up paying tax you don't need to, and that's tax that you can't reclaim. With an offshore bond, you're going to get the full benefit of the growth that you achieve.
I've heard about segmentation. Does that give more flexibility in the UK?
Segmentation does allow more flexibility to the bondholder. Segmentation allows the bondholder to target their withdrawals more efficiently to allow them to either stay within a certain tax band or to stay beneath the 100,000 threshold. Segments can be gifted to a third party such as an individual or a trust, and in most cases the new owner of those segments would be liable for UK income tax at their marginal rate. Additionally, it gives planning opportunities as segments can be gifted to fund school fees or a new home purchase.
How might a trust be used with an investment bond?
Well, a trust can be used to help mitigate UK inheritance tax and provide controlled intergenerational planning. Most offshore providers provide a suite of trusts that can be used with products, or the trustees can apply for a bond using their own external drafts. Inheritance tax is currently charged at 40% for UK domiciles based on their worldwide assets, above certain thresholds. Some radical changes were announced in the 2024 spring budget to shake up the inheritance tax rules. For example, shifting inheritance tax from a domicile-based system to a residence-based system. However, the same principles and benefits will apply under the new residence-based inheritance tax system, providing the same benefits for offshore bonds. Offshore bonds can be used with trusts to allow really efficient tax planning, as the bond itself is a non-income producing asset, so it really simplifies the reporting and trust taxation quite considerably, especially when considering discretionary type trusts. This allows for efficient planning by allowing trustees to assign policies and shift that tax liability to the beneficiary, who could be, say, a basic rate taxpayer. Using bonds and trusts is certainly very effective for intergenerational tax planning. Further, various tried and tested trusts can be used to further mitigate inheritance tax, including discounted gift trusts, reversionary interest trusts, loan trusts, and these types of schemes are offered by most offshore providers.
What are the investment options available with investment bonds?
These products have a really wide spectrum of investments that can be selected, ranging from mutual funds, investment trusts, cash deposits and exchange-traded funds, ETFs. If the policyholder likes, they can assign the investment management to a discretionary fund manager to look after all of the investment activity for them.
What are the other tax advantages of investment bonds?
Policies can be assigned in whole or in part to a new owner. This has the ability of shifting the tax charge onto the new owner, which is a really valuable advantage when compared to other directly held assets which could give rise to a capital gains tax charge.
Well, there are certain tax advantages for insurance bonds when looking at UK taxpayers. Firstly, top slicing relief can reduce a person's exposure to higher rate tax by applying a spreading mechanism to the chargeable gain. For example, on surrender, the final chargeable gain is divided by the number of years the bond has been held. This sliced gain is compared with the full gain. Any resulting differences can allow for higher rate tax relief. For policyholders that have spent time overseas, there is also a potential reduction based on the proportion of time they've spent overseas in the period that they have been liable to tax.
Why would an advisor use a provider based in the Isle of Man?
Well, financial services has been firmly established in the Isle of Man for over 40 years, and as a result of that you've got a strong pool of resource, very experienced people, and that's continually being refreshed and is obviously a great advantage to the island. In terms of its contribution to the island's GDP, financial services is the biggest contributor to that, which makes it a leading light for the island and very strongly supported by the government. And there's also a very good, robust regulatory framework, which is obviously very helpful for any advisors and their clients looking to invest out here, with a long track record and a very sound regulatory structure. And of course you also have access to UK markets via legislation.
Are investment bonds still relevant in today's financial planning environment?
Yes.
Yes, very much so.
Absolutely.
Definitely.
Increasingly so.